Let's actually bring in Alan Knuckman, who joins us live now from Bullseye Options for a bit more on what we're seeing with that VIX index. Alan, great to have you with us, and thank you so much for joining us. Now, it certainly does appear after months of relatively quiet range trading for that VIX index, it might start to be on the rise. And I know that we've spoken to you about that range trading for the VIX. Do you think that volatility will start to pick up as we head into the end of the year?
No, not necessarily. I think the market's going to continue to move higher. We may see some profit taking after sell the fact with the tax package. But the overall trend in the VIX obviously is very much lower. If you look at the overall action in the last 5 years, 7 years, 8 years. Now, what we had last week was the same thing we've seen many times before, that VIX explosion. We went up to 1450 and got whacked right back down. We're back down to 10. But let's be aware, we're significantly higher, even though stocks are making all-time forever highs, we're significantly higher than the low that we've seen in the VIX. So more downside in the VIX, more upside in stocks. We've been saying this for a while, so I don't think anything's changed.
You talk about that VIX explosion. Option volume as well was very, very strong for the VIX index there.
Huge.
Tell us a bit more about that, the volumes.
Well, it was 5 times normal volume, but what the price action is what we want to keep track of was obviously very negative. The fact that it spiked up and then came back to essentially unchanged when it was all said and done with all the nonsense we saw on Friday, that's very telling. And that tells us the overall trend is still very much intact. Between 10 and 12 for now going on 7 months with these periodic breakouts that come right back down inside the channel, that still targets 8. 8 is the downside target in the VIX, so we still have some work to do on the downside. Volatility can get more complacent, and we'll start thinking about in the next coming weeks, obviously about the holidays, but about the earnings season that starts again the second week in January. That oftentimes gives the market a little bit of a boost as we go into that new season.
Let's talk about some of the moves there specifically today. And once again, we are watching that rotation out of those tech names, Alan, and it actually seems like a bit of a repeat of what we saw on Wednesday last week. What do you think about this? I mean, do you think that perhaps tech stocks are now firmly out of favour, or do you think perhaps this is just a pause?
No, I'm not ready to make that kind of call yet. It's just one day, and as we've seen many times before, you get this unwind, this profit-taking round, and money kind of moves around, but it does come back. So let's wait to see how it comes back, and every time it's bounced back and made new highs. I don't think it's any different this time. Just look at the performance of some of those tech stocks. We had the NDX index up more than 30%. Now, the Dow is actually starting to play catch-up, and I think we were up 22%, had a 3% week last week in the Dow. Again, it's only 30 stocks, and it's weighted by price, not capitalization, so it's not a fair measure of the market. But the S&P continues to make new highs, new highs, new highs, even though it is lagging behind. I think it's just rotation, but that's why we want to watch these markets, see how far it falls, and look to buy against a support level, and for it to recover the distance of that drop on top of those old highs. That's the next measure move objective, and that's worked every time I've told you now since this rally started back in 2009.
Are you participating in this rotation, Alan?
Well, I'm looking at some better value stocks. I talk about that often where, there's still a lot more upside in the Amazons and the Apples and the Facebook. There's still a ton more upside. But from my comfort level, I'm not comfortable buying here because I think there's more risk than there is reward at these levels. I would want to wait for a bit of a sell-off, but I'm looking at some more value type stocks. I think last week we talked about Freeport-McMoRan. This week I'm looking at a stock, Merck. Merck got crushed on earnings, even though they beat their expectations at the end of October. They got knocked down, and it's been trading between 54 and 56. Now today it's broken out above 56, and so that looks like it's going to try and fill in that gap. And let's remember, something like Merck is down 5% on the year. So from a reward to risk perspective, it's a much better play for me personally, my personal trading style, than jumping on board a train that's already left the station and has been on the tracks for weeks and weeks and weeks. There's risk there that I don't like to deal with personally.
Yeah, sure. What about the banks? Because as we've been seeing there today, obviously that rotation into some of those stocks that perhaps will benefit from a lower corporate tax rate. Everyone's saying that will obviously, continue to drive this market rally. What about the banking sector and some of those industrials that we are seeing that rotation into today?
Well, the banks are a great example of the strategy that I try and employ is to buy the dips and sell the rips. Now, we just exited Bank of America, missed out on the additional surge today, but still, you're never going to pick the top of the market. And since I use options, I'm looking for a specific payoff that's looking to be more than 50% return in a reasonable amount of time as opposed to buying the shares of stock. So I can amplify my returns in a small stock move using the right option strategy. So I'm using this as an opportunity to lighten up on positions. I want to be selling when the markets are having these melt ups, and I want to be buying when they're having the dips and look to see how they hold specific support levels.
If we talk about a market that is seeing a bit of a dip there today, we're watching oil sort of tracking lower there. That's because the market is still trying to weigh up a bit of excess US production there. Of course, against that OPEC meeting where we saw the extension of those production cuts last week. What about the dip for the oil price? Are you looking at perhaps some of those energy plays as a bit of an opportunity?
Yes, definitely. Energy stocks and mining stocks are in my wheelhouse right now. When it comes to energy, it's really interesting the way the markets acted last week. When the announcement came out from OPEC, there was absolutely no change on the day. So even though the markets had been anticipating a 9-month extension, there was still a possibility it was only going to be 6 months, but there was no reaction at all. Fully baked in the case, the market had priced it in. But what you did see on Friday was a rebound back to those 2.5-year highs at $59 a barrel. So that projects a move to 61. And as I've talked about weeks ago, 65 is still the near-term target because of the range that we traded between 45 and 55 for most of the year. That's the upside target. So it's still steady up ahead. And even though production is increasing here in the States as far as the shale oil goes, demand around the world because of the global reflation, that's also picking up. So that's picking up the slack. And I don't think the producers are going to get ahead of themselves here in the States. I think they've learned their lesson. They're very happy with $55, $60 crude. They don't want to upset the apple cart just yet.
All right, fantastic. Look, Alan, always enjoy talking with you. We do appreciate your analysis today. Thank you so much.
Talk to you next week.